Assalamualaikum and hi everyone. Welcome back. This is the second video on Mfrs 110, events after reporting period. And in this video, we're going to focus on the illustrative examples for both events after reporting period, namely the adjusting events and non-adjusting events. We're going to look at the accounting treatment for adjusting event. Recall that adjusting event is actually those that provide evidence of conditions that existed as at the reporting period, as at the end of the reporting period. And we also going to look at the accounting treatment for the non-adjusting event. Recall that the non-adjusting event is those that are indicative of condition that arose after the reporting period. The difference between these two is that here the condition existed as at the reporting period, but here there is no condition that existed as at the reporting period. And for the adjusting event, you will see that we are going to show how do we provide adjustment to the financial statement regarding those amount that has been earlier recognized, and also looking at the accounting treatment for non-adjusting event where no adjustment will be provided, but we're going to look at how do we provide disclosure notes to the financial statement, focusing on the nature of the event and the estimates of its financial effects, or the statement that such an estimate cannot be made. So let's start with the first illustration, which is illustration 4, and this will illustrate adjusting event. Loss on trade receivable account of 100,000, which is confirmed by the bankruptcy of the customer, occurs after the reporting date. So meaning that after the reporting date of the company, the entity has no prospect of recovering any money. Reporting date perhaps is 31st of December 2000 x3, for example. So entity estimates for the risk of trade receivable and account for the expected credit loss, the ECL as per Mfrs 9, and its allowance for impairment. So a condition that existed as at the reporting date is very important for you to determine whether it is the adjusting or non-adjusting event. So in our case, the events that occurred here is the bankruptcy of the customer that happens after the reporting period, after reporting date. That provides evidence. Remember, the definition is events that provide evidence on the condition that existed as at the reporting date. So the condition that existed here is the where the allowance have already been made for the trade receivable, allowance for impairment, for the expected credit loss, which is actually estimating the credit risk of the customer that went bankrupt. That has been estimated. Then the type of event here, this is adjusting event, because when the company goes bankrupt, the customer goes bankrupt, and it happens between the reporting date and before the date the financial statement are authorized for issue. Here we assume that the financial statement have not yet been authorized for issue. So this would be adjusting event, and therefore company need to meet an accounting treatment here where adjustment need to be made to the financial statement of the company. How to write off the bad debts? How do we write off bad debts? We are going to write it off by reducing the trade receivable account, which is to credit the trade receivable account by 100,000, and decreasing the allowance for impairment. Remember to reduce the allowance that you have earlier been made for the uncollectible receivable, and now it is confirmed that it is no longer it is going to be a loss for the company because of the no prospect of recovering any money from that bankrupt customer. So that will reduce both account with 100,000, and it is an adjusting event. Next we go to illustration 5, which is about a fraudulent claim which are approved by the company for the purchase of goods items amounting to 30,000, where the purchase clerk did not buy during the reporting period ended 30th of April 2006, and this is the reporting date here, and the year end is 30th of April 2006, and that was detected after the reporting date, which is 13th of May. So that was after reporting date, but that was before the approval of the financial statement for issue by the director. So AD, authorization date. So the events is after the so-called events after reporting period, and since there was a fraud to the financial statement, that fraud must be corrected. So that was detected, and therefore the condition that existed as at the reporting date is that there was already a fraud that has occurred during the reporting period, and the events, which is the detection of fraud, was detected on 13th of May, and this is going to be adjusted, or else the financial statement will provide incorrect figures, and therefore discovery of fraud in terms of accounting treatment shows the indication that financial statements are incorrect and that need to be adjusted for the period ending 30th of April 2006. That was the year end or the reporting date. The company should adjust the financial statement and reflect the correct balances, do the correction of error as at the year end, and therefore the fraud expenses should be increased to the statement of profit or loss, as well as reducing the purchase that was not even made in the profit or loss. So that both must be reduced. The fraud expenses is being increased, the purchase fraud expenses is being increased, but the purchase is being reduced. Both is in the statement of profit or loss. Next, we go to illustration 6. Illustration 6 is about a company that were facing a lawsuit. So you can read this about this company called XS Berhad, where it faced a lawsuit for the product that it sold, which is the health and beauty product that actually lead to a fatal accident involving the customer that consumed the capsule when the management was preparing the financial statement. So the consumption of the capsule was somewhere during the reporting period, ended 31st of December 2006. That is the reporting date. Identify the reporting date. The parent of the customer was claiming 5 million, so there was a lawsuit of 5 million asking for compensation from our company XS Living Berhad, and because the only child was died after consuming the capsule. Few days before the board authorized the financial statement for issue, so meaning that before it was authorized for issue, the court made a decision and has instructed the company to pay the compensation of 3 million. So now it becomes a liability to the company because there was a verdict by the court. Before that, it was just a contingent liability. So now we need to look at what happened to the company. There was a claim, and before the board was authorized the financial statement for issue, the court made that decision for the company to pay the compensation to the parents that lost their child. So in accordance with Mfrs 110, you have to explain the nature of event, either adjusting or non-adjusting, and also appropriate accounting treatment and the adjusting journal entry. So let's look at what you have here. This is an adjusting event. Why? Because the sale of the product and also the death of the customer together with the lawsuit claim has already existed. So meaning that the condition has already existed as at the reporting period. So the decision of the court is the one that provide evidence of the condition, further evidence. The court decision which instructed the company to pay the compensation is the one that provide evidence. So this is actually the reason it was an adjusting event. And the decision that was made was before the financial statement was authorized for issue. So the decision confirmed the company had a present obligation, which is to provide a liability as at the reporting date. Financial statement must be adjusted because the decision confirmed that the company has a present obligation, which is a liability. So therefore, the company needs to adjust the financial statement. How? Recognizing a provision which is a liability under Mfrs 137 for lawsuit of 3 million as part of its liability. Provision is a liability in the statement of financial position and increases the lawsuit expense where in the statement of profit or loss by also 3 million. So the adjusting journal entries will be as follows. So you need to go and increase the lawsuit expenses as well as increasing the liability in the SOFP, the provision for lawsuit, and that was for 3 million. Next is illustration 7. This is still relating to the illustration for the adjusting event. You have the company which is at the end of the reporting date, the company called Camellia. The reporting period was 31st of December 2000x3. The carrying value of the inventory was 55,000. This is the cost of the inventory, the carrying value at cost, and the NRV was 60 million. So here you can see the NRV is higher than the cost, so the asset will be measured at cost of 55,000, as MFRS 102 stated that the inventory must be measured at the lower of cost or the net realizable value. So we take the lower figure, and therefore there is no need to write down the inventory at this point. However, as the carrying value was lower than the net realizable value, the inventory was disclosed at 55,000. No adjustment was yet made. Then you have this information after the reporting date. The inventory was then sold off for 55,000. So now you can see that from 55,000, which is the cost of the inventory, now it was sold off for 54. Now you could see that there was a reduction in the sale price of the inventory to 54,000, and that happened before the authorization date. AD here, reporting date is here, and the event took place 1st of March. So therefore you need to go and adjust the financial statement, since the carrying value of the inventory was being overstated. If you still maintain at 55,000, you need to reduce it down to 54,000, and that must be reflected in the financial statement. So let's see what you are being required here. You have to explain the nature of the event. Of course, you know this is adjusting event. Explain the appropriate accounting treatment. So you must do it according to MFRS 102 treatment, and also show the adjusting journal entry for the accounting treatment. Right, so inventory was being sold off is the event that took place, and that was on 1st of March 2004. And the answer to that, you know that this is an adjusting event. The reason is because inventory of course shall be measured at the lower of cost and the NRV. And here the measurement of the NRV is an estimate. Earlier it was 60,000, but and that is the reason you measure it at cost. And the actual proceed that was received on 1st March for the subsequent sale of the inventory after reporting period provide further evidence on the condition that existed, that the inventory must be now written down to 54,000. So the carrying value of the inventory that was at cost will now be written down to 55,000, since it was being overstated or overvalued as at the reporting date. And 1st of March is before the authorization date, and the adjustment must be made to the financial statement. How? You have to reflect the adjust amount recognized in the inventories account as well as cost of sale. You need to reflect that by doing adjustment, increasing the cost of sale in the SOFP, in the SOPL by 1,000, the cost of sale. This is the difference between the cost and the selling price, which is the the value of the inventory that took place after the reporting date, the sale price of the inventory. And you need to write down the carrying value of the inventory by 1,000, which is the difference between 54 and 55,000. So the cost of sale must be increased by 1,000, the difference between 55 and 54,000. And the inventory must be written down by 1,000. So there should be a write down of inventories from cost to the net realizable value, which is actually the estimated selling price less estimated selling cost. And our figure there was 54,000. So that will reduce the inventory to 54,000. And you must make adjustment to the statement of profit or loss, and also the extract statement of financial position. Do you have another illustration? Illustration 8, which is on this illustration to illustrate the non-adjusting event. You have a company, Rich All Berhad, which is a toy manufacturer, operates 4 different classes of product division: Super B, Battle B, Crash B, and Metal B. Division are all material. So this is very important to the financial statement of the company. The financial year end is on 30th of June. So this is the reporting date. And in early August 2003, the company decided to discontinue. They made decision to discontinue the division called Crash B. So decision was to discontinue, stop operation of that division. Why? Because of high intense of competition, and also it has been incurring heavy losses, but heavy losses were not informed how much. Announcement of this a plan to discontinue the division was on 1st of September, and that was before the authorization date, since you are informed in the last sentence here. So in accordance with Mfrs 110, you are asked to explain the type of the event and describe the appropriate accounting treatment. There are no figures for you to adjust, if you can see, and this is the reason, one of the reasons that it is also a non-adjusting event. So why it is non-adjusting event? Because decision to discontinue the division only took place subsequently after the reporting period. So there was no condition that exists as at the reporting date, as at the end of the reporting date, 30th of June 2003. So decision only arose, which is after the reporting date. There is no accounting treatment needed. Why? Because this is just a disclosure that you need to inform to the owners or to the shareholders, and there will be no adjustment to be made in the financial statement. However, because division earlier on was considered to be material, which means that it has significant impact to the financial statement, therefore the company will need to provide disclosure notes. So then they have to provide disclosure notes to the financial statement, describing or showing the nature of the event, the closure or discontinued division, Crash B here, and the estimates of the financial effect, which is the loss, if any. So here, no information on loss. So if there is such information, you need to put the estimates here. Just putting another statement that such an estimate of loss cannot be made or has not been made yet. And that was non-adjusting event, and you will not adjust in the financial statement. There was just a disclosure to be provided. Next is about a company, Mio Berhats, which has a financial statement for the year ended 30th of November 2000X1, and this is the reporting date or the year end. It was authorized for issue on 15th of January 20X2. So this is the authorization date. And on 27th of December 2000X1, this is the date where the event after reporting period took place. There was a massive flood, which is a natural disaster that occurred, and that flood has caused extensive damage to the inventory, property, plant and equipment, and other assets of the company, Mio Berhad, that is located in Selangor. So the estimated amount of loss was 800,000. So the estimate is available. Decision, the event took place somewhere before the date of authorization for issue, which is on 27th of December, and authorization date is 15th of January. So this is events after reporting period. You need to explain whether it is adjusting or non-adjusting, describing the appropriate accounting treatment of the above event in line with Mfrs 110, and providing disclosure notes to the financial statement where necessary. Providing means you need to write the notes, sample notes of the event that is to be accompanied in the financial statement. as a disclosure. Now, this is a non-adjusting event. Why? The natural disaster, which is the worst flood or the massive flood, occurred on 27th of December, which is after the reporting period. Reporting period is actually 30th of reporting period ends on 30th of November. So the year end is the reporting date, 30th of November. So therefore, no condition or no flood yet has existed on that date. So there was no condition. The condition arose after the reporting period. So no accounting treatment is needed for this situation. There will be no adjustment in the financial statement ending 30th of November 2000x1, the current year. However, the massive flood, the natural disaster there, has material significant impact to the company because it has actually damaged their PPE, their investment property, and also the inventories and other assets, and therefore it should be disclosed, as if you do not disclose, non-disclosure would affect the ability of the users in making proper evaluation and decision. So they should have enough information on what they are evaluating, and decision should be based on the financial statement of the company mainly, and therefore company needs to provide, Mio Berhad needs to provide the disclosure notes to inform the users of the financial statement or whoever interested party, the nature of the event and the estimates of the financial effect. This is in accordance with the disclosure rules of the Mfrs 110. So you need to provide a sample disclosure. So state the date of the event and what are the type of the event, when does it take place, what are the type of the event, and that damage that has been done to the asset of the company. And the company here is Mio Berhad. It's not Surya, it's Mio. And therefore you will have to also state the estimated amount of loss. It is available of 800,000. And the statement that the financial statement for the current financial year did not reflect the amount of loss. So remember, the company is Mio Berhad. Next is the illustration 10, still under non-adjusting event. It's about a company that involved in the tourism business. The company closed account on 30th June every year, and the year end is the current year end, 30th June 2007. This is the reporting date and the year end. And the authorization date for issue was 1st of October. So this is the authorization date. So any event between the two dates are event after reporting period. And the company has one branch in Sheffield, United Kingdom. And due to the overwhelming response, the company announced a capital commitment, which is one of the example under Mfrs 110 regarding the non-adjusting event, that it would open another branch in Essex County, still in the UK. The estimated initial expenditure or the capital commitment, the estimate of it only is 1.88 million. The company has not yet paid for any amount. It was just an estimated amount. The announcement was made on 1st July, right after the year end, one day after the reporting date, right, 1st of July. This is the date the events after reporting period took place, EARP. So you are being required by the financial director of the company to comment on the financial statement, whether do you need to adjust the financial statement or you just need to disclose notes to the financial statement regarding the event. And why do you need to adjust? Explain that to the matter that were listed above in accordance with Mfrs 110, and if that is also in line with other standards. So the answer here is that was according to paragraph 22 of Mfrs 110. This is listed as a non-adjusting event, capital commitment, as the announcement occurred after the end of the reporting period, that was on 1st of July. There will be no adjustment to be made to the financial statement of the company as at the reporting period, the current reporting period, 30th of June. If you can recall, it was 30th of June 2007. So that was the current reporting period, and that was the year end. So I put here 30th of June 2007. And the details of the announcement, however, must be disclosed in the notes. So you need to provide disclosure to the financial statement describing the nature of the event. To open the new branch is your plan, where the branch is in assets, and the estimate of the future financial effect of 1.88 million. So that must be disclosed in your sample disclosure notes if you are required to do that. Next one is the last example, which is illustration 11. This is about a company called Tin Tong Berhad that has an investment. The investment worth 2 million. And that was stated in the financial statement 31st of December 2006. That was the year end of the company. Reporting date is 31st of December 2006. And due to the global pandemic, that has attacked the whole world, it also had impact on the financial market, right? Perhaps it's the COVID-19 pandemic. So the investment now declined in value to 1.6 million. So from 2 million, now reduced by 400,000 by to 1.6 million on 24th of January 2007, which is after reporting date, but before it was authorized for issue on 23rd of March, authorization date. So this is events after reporting period. You are asked by the board of directors again to comment. Comment is either, is there any adjustment needed in the financial statement? If yes, what are the adjustments? If there is no adjustment, why? And what are the disclosure notes that you need to provide? Explain that by doing that in accordance with Mfrs 110. So the last event is as per paragraph 11 of the standard. This was mentioned as a non-adjusting event where there is a drop or decline in the fair value of the investment, since this does not normally relate to the condition of the investment. The standard prescribed that the decline in the fair value of the investment does not relate to the condition. So the condition did not exist as at the end of the reporting period. However, the decline or the drop reflect the circumstances that have arisen subsequently, which is that the one arose after the reporting period, and assuming this is before the date the financial statement were authorized for issue. As were mentioned here, it was on 23rd of March. Okay, so the last part is whether the company needs to adjust the financial statement. Here there is no need to adjust the financial statement, so there is no accounting treatment in terms of debit credit to adjust the financial statement for non-adjusting event, or to update this amount disclosed in the financial statement. You don't have to go and update 2 million and show the reduction of 400,000. That is not necessary. However, the company need to provide additional disclosure notes to the financial statement stating the nature of the event, and also the decline in the value by way of notes to the financial statement. With that, I thank you for watching. I'll see you when I will see you. Will see you in next video. I hope that this video gave you a lot of benefits to understand the accounting treatment for events after reporting period, for both adjusting event and non-adjusting event. Till then, I'll see you when I will see you. I'll see you in my next video, and then have a pleasant day ahead. Assalamualaikum.